Picture this. You're 73 years old, sitting on a retirement portfolio worth $800,000, and the IRS just sent you a letter that makes your heart skip a beat. You missed your required minimum distribution deadline, and now you're facing a penalty that could cost you tens of thousands of dollars. But here's what's even worse. You're not alone. Over 80% of American retirees are making critical RMD mistakes that are silently destroying their retirement income and potentially triggering massive tax penalties they never saw coming. Now, I'll reveal the 7 deadly RMD mistakes that could cost you up to 25% of your retirement savings in penalties alone. You'll discover why Harry, a 74-year-old retiree from Arizona, lost $47,000 to a single RMD error he didn't even know he was making. More importantly, I'll show you the exact strategies financial advisors use to help their wealthiest clients avoid these traps, including a little-known IRS provision that could save you thousands in taxes this year. Now, before we dive in, this is for educational purposes only. I'm not a financial advisor. Please consult professionals for personalized advice about your specific situation. Let me tell you about Harry. He worked for 42 years as an engineer, diligently contributing to his 401k and traditional IRA. By the time he retired at 70, he'd built a respectable nest egg of $1.2 million. Harry thought he had it all figured out. He'd read the articles, watched the videos, even attended a few retirement seminars at his local library. But there was one thing Harry didn't fully understand, and it nearly cost him everything. You see, when Harry turned 73 last year, he became subject to something called required minimum distributions, or RMDs. These are mandatory withdrawals the IRS forces you to take from your tax-deferred retirement accounts like traditional IRAs, 401ks, and 403bs. The government essentially says, "We've let you defer taxes on this money for decades. Now it's time to pay up." But here's where it gets terrifying. According to recent industry data, over 80% of American retirees are making fundamental mistakes with their RMDs. And the penalties? They're absolutely crushing. Miss your RMD, and you could face a penalty of up to 25% of the amount you should have withdrawn. That's on top of the regular income tax you'll owe. Think about that for a moment. If your RMD was supposed to be $40,000 and you forgot to take it, you could be looking at a $10,000 penalty. That's money straight out of your pocket, gone forever, for a simple oversight. But it gets worse. The mistakes aren't just about missing deadlines. Kiplinger recently identified 7 critical RMD errors that retirees make every single year, and each one can trigger devastating financial consequences. Some retirees are using the wrong life expectancy tables, calculating their distributions incorrectly. Others are trying to aggregate accounts that can't legally be combined. And almost nobody understands the special rules for inherited IRAs that changed dramatically under the Secure Act. Harry fell into multiple traps. First, he thought he could delay his initial RMD until April 1st of the year after he turned 73, which is technically true. But what nobody told Harry was that delaying meant he'd have to take 2 RMDs in the same tax year, his first one by April 1st and his second one by December 31st. This double withdrawal pushed him into a higher tax bracket, costing him an additional $8,400 in taxes he hadn't budgeted for. Now, let me share something that might shock you. The JP Morgan study I mentioned earlier analyzed 31,000 data points from the Employee Benefit Research Institute. What they found was that 84% of people withdrawing from their defined contribution accounts only took the required minimum, and 80% waited until they were legally required before touching their retirement funds at all. On the surface, this might seem prudent. You're preserving your capital, right? Wrong. This approach creates a dangerous misalignment between when you need money and when you're taking it. Let me explain with a personal story that changed how I think about retirement withdrawals forever. My grandmother lived to be 100 years old, a true centenarian. When she was in her 60s and early 70s, she had energy, enthusiasm, and the physical ability to travel the world. She took our entire family on a cruise for her 80th birthday, creating memories that last to this day. But here's the critical point. By her late 80s, she'd moved to a single-level condo in a retirement facility. Her world had shrunk. not because of money, but because of energy and mobility. This is the fundamental flaw with the RMD-only approach. According to the standard RMD tables, if you have $100,000 in a traditional IRA and only take required minimums, assuming even a conservative 4.6% return, your peak spending years would occur between ages 93 and 97. Think about that. Your highest withdrawal rates happen when you're least able to enjoy them. But here's what's even more interesting. MarketWatch recently reported that market volatility is making RMD calculations increasingly complex. If you're forced to take your distribution during a market downturn, you're essentially locking in losses. You're selling low when you might otherwise wait for recovery. Harry discovered this the hard way when the market dipped 15% right before his RMD deadline. He had to sell more shares than anticipated just to meet his required distribution amount, permanently reducing his portfolio's recovery potential. So what's the solution? Well, Barron's just revealed several strategies that wealth managers use for their high net worth clients. The first is something called a Qualified Charitable Distribution, or QCD. If you're charitably inclined, you can transfer up to $108,000 directly from your IRA to qualified charities. This counts toward your RMD, but doesn't increase your taxable income. It's like getting a tax deduction without itemizing. Harry learned about QCDS from his new financial advisor after his costly mistake. He now donates $15,000 annually to his favorite charities directly from his IRA, reducing his tax liability by approximately $3,300 each year. The second strategy involves strategic timing. Instead of waiting until December to take your RMD, consider spreading it throughout the year. This gives you flexibility to withdraw when markets are favorable and can help with tax planning. Some retirees even take their entire RMD in January, investing it in a taxable account where it can continue growing without future RMD requirements. But perhaps the most powerful strategy is Roth conversions before RMDs begin. Every dollar you convert to a Roth IRA is a dollar that won't be subject to future RMDs. Yes, you'll pay taxes on the conversion, but if done strategically during low-income years or market downturns, it can dramatically reduce your lifetime tax burden. Let me show you exactly what this means with real numbers. Harry's portfolio started at $1.2 million. Under the traditional RMD-only approach, his first required distribution at age 73 would be approximately $45,283. By age 85, assuming 6% annual growth, his RMD would jump to about $73,000. And by age 95, if he's fortunate enough to live that long, his annual RMD could exceed $120,000. Now here's the plot twist nobody talks about. Those massive distributions in your 90s don't just mean higher taxes. They can trigger the Medicare Income-Related Monthly Adjustment Amount, or IRMAA, causing your Medicare Part B and Part D premiums to skyrocket. They might also subject more of your Social Security benefits to taxation. Harry's advisor ran projections showing that by implementing a combination of strategic withdrawals, QCDs, and partial Roth conversions, he could reduce his lifetime tax burden by approximately $267,000 over 20 years. That's assuming he lives to 93, which is increasingly common given today's life expectancies. But here's what really opened Harry's eyes. The advisor showed him how taking slightly more than the minimum in his 70s, when he still had energy to travel and enjoy life, actually improved his financial security in his 80s and 90s. It seems counterintuitive, but by smoothing out his withdrawals and managing his tax brackets proactively, Harry could spend more in his active years while still maintaining financial security for potential long-term care needs. The most overlooked aspect? The still working exception. If you're over 73 but still employed, you might not need to take RMDs from your current employer's 401k. But be careful. This exception doesn't apply to IRAs or former employers' plans. Harry's friend learned this the hard way, thinking he could skip RMDs on all his accounts because he was still consulting part-time. The IRS disagreed to the tune of a $15,000 penalty. There's also the aggregation trap. You can combine RMDs from multiple traditional IRAs and take the total from one account. Same with 403bs, but you cannot combine IRA and 401k RMDs. Each 401k requires its own separate distribution. This seemingly minor detail trips up thousands of retirees annually. So here's what you need to do today. First, if you're approaching 73 or already there, calculate your RMD for every tax-deferred account you own. Don't guess. Use the IRS life expectancy tables, or better yet, consult with a qualified tax professional. Second, consider whether QCDS makes sense for your situation. If you're already donating to charity, this could save you thousands in taxes immediately. Third, and this is critical, review your beneficiary designations on all retirement accounts. The inherited IRA rules changed dramatically, and your beneficiaries now typically have only 10 years to empty inherited accounts completely. Without proper planning, you could inadvertently create a tax bomb for your heirs. Finally, stop thinking of RMDs as just another government rule to follow. Think of them as part of your comprehensive retirement strategy. The goal isn't to minimize withdrawals at all costs. It's to maximize your quality of life while maintaining financial security. What's your biggest RMD concern? Are you worried about penalties, tax implications, or managing market volatility? Let me know in the comments below. And if you found this helpful, check out my next video on how to use your 401k strategically to maximize Social Security benefits. It's a game changer most retirees never consider. Remember, the difference between those who thrive in retirement and those who merely survive often comes down to understanding these critical details. Don't let RMD mistakes rob you of the retirement you've worked decades to build. Your future self will thank you for taking action today.